The consumer is sending massive signs of weakness, and the Fed is at an impasse because they're about to make a move that they have never done in 50 years. And this move is expected here this week, but it's going to send tidal waves throughout the rest of the world and the global economy because cutting interest rates in an environment like this has been detrimental for many other countries and many other central banks. But why does the Fed think that this is going to be different for them? And Jerome Powell has been citing Paul Volcker, but it's Paul Volcker's predecessor that is maybe who he is more like. We're going to dive into all of this. But first, we've got to dive in to the non-farm payrolls and seeing this drastic weakness here in the U.S. labor market because this non-farm employment has fallen 9,000 jobs in November, making its second consecutive monthly decline. Now, with all of this, right? I mean, you have it so easy to create jobs with LinkedIn, Indeed, all of these different aspects and job boards. But why are we seeing the job market and the jobs data slow down? Well, it's not because there aren't people that are in need of work. Of course, we've seen unemployment tick up here a little bit here recently as well. But it's taking it a step farther, the consumer weakness is running deep throughout the entire economy. So when you keep on trucking down all of this, private employment dropped nearly 20,000 jobs. But government employment, they added 10,000. Well, the reason why government employment added 10,000 is we literally had a government shutdown. So these numbers could actually be worse. Furthermore, the decline was revised to even lower. And that's the crazy thing is when you keep looking at all of these job numbers and how they keep getting revised and keep going worse and worse and worse, you have to ask yourself, is this jobs data even reliable? Because it never gets revised to the upside, it seems these days, and it's already coming out as bad. So is it going to be even worse here in 12 months? I mean, time will tell, and we're going to keep watching and monitoring all this. So make sure you guys are subscribed. But it brings the downward divisions to nearly 100 or nearly 200,000, I guess 150,000, let's say, in the past 4 months. So it keeps getting written down even more and more and more here. And so these non-farm payrolls are now posted 5 declines over the last 7 months. It's worst streak in 5 years. So you might ask yourself, okay, what else is going on? Well, the Fed is now tightening its balance sheets. You're seeing quantitative tightening. Well, is that over? Right? Because the Fed has reduced its assets by 2.4 trillion, 27% during its QT tightening. This unwound 57% of the $4.8 trillion. The Treasury securities declined $4 billion. Mortgage-backed securities, I mean, all of these things happened, but now we're starting to see a little uptick here. Because QT is officially over. Because here, we all know it's going to happen in just about 3 days here. I mean, it's an 86% chance that they cut interest rates by 25%. Or 25 basis points, excuse me, not 25%. That would be crazy if we had interest rates that high, folks. But as we see, the potential of more money, more liquidity getting into the market, this is where we're going to see this asset bubble thesis that I've been talking about for a while start to play out. Because everybody thinks that, hey, the more liquidity that we see in the market, they're just going to dump it into assets. Okay, maybe in the short term, we could see some dumping, and that dumping would cause, some short-term negative price action. But in 3 to 6 months following quantitative easing breaking off, I mean, they say it, right, all the time. You need 12 to, 6 to 12 to 18 months even at the extended period to see some of these layover effects of the policies that we do today actually take place. And so we started this rate cutting cycle, 3 months ago or so in September. So maybe, come May time is when we'll start to see this run up again. So maybe we'll be crab walking up until then because the liquidity is not going to immediately dump in. We don't see all of that. But if we don't cut interest rates, which there's only about a 13% chance that we don't, that's where I think we would see a major dump in the market and things would be code red here. But obviously, we've got a new Fed chair coming in here in May, and they're going to want low interest rates, just like Trump has been clamoring for. And that's when, we're going to start to see some interesting policies start to come about. But I think the interesting thing that we also are seeing is that I'm lining out how the consumer actually is showing major signs of weakness. Yet the consumer sentiment here is actually ticking higher. So the consumer is saying, hey, we're seeing greener pastures ahead. Although inflation is still running hot, although, it's been the tariff war. They've been clamoring about the tariffs in the headlines for quite some time. All these negative things about the Trump economy and, the potential of this frozen job market and rising prices. But the consumer sentiment, at least the preliminary reading, who knows at this point? I mean, it is a university reading opposed to, maybe some of these public sector readings. All of this is ticking up. Even though we also saw consumer spending stalled in September. Now, obviously, we're coming to you live here in December, folks. So make sure you guys are smoking that like Cheech and Chong and subscribe to the channel because 92% of you guys aren't. But we are seeing the consumer spending stalled here right ahead of this holiday season. And so I think it's going to be interesting when we see the reports coming out in early next year, how this holiday season is going. Because normally, of course, we see consumer spending go up, all of these people buying gifts, you name it, right? So as we start to peek in and watch how this is playing out here, right? We're going to really be tracking how like the consumer staples like Walmart, Target, all of these places are really doing, right? Because the deeper that we get into this quote unquote recession, the more that the consumer will be hurting. And right now, the consumer's showing a lot of mixed signals, folks. The consumer's looking you in the eye across the bar, giving you the, hey, come over and talk to me, buy me a drink eyes. And then you get over to the consumer and they're saying, what are you doing here? I have a boyfriend. I mean, that's what we're seeing over here, folks. But this December decision is going to be interesting, right? Because, not only is it going to tell a lot about this market, we've got a huge week ahead because, we've got the JOLTS report, Fed interest rates decision, the press conference, one of Powell's last press conferences. I mean, it's on a slim number here. OPEC monthly report, jobs claim, the 30-year bond yields. All of this is going to be very telling. And then we're seeing the dollar start to weaken. And actually, the dollar probably potentially having the worst year. I've been covering saying it's been the worst start to the year. That's what I've been saying for the past 3 months. But I can't even say it's the worst start to the year because the year is almost over at this point. So it's one of the dollar's worst years in history since we went off the gold standard in 1971. It's literally the worst year since 1953. We're at 98, just under 99 for the Dixie. Yet all of this, while the S&P 500 is ticking up near those all-time highs. So those all-time highs are at nearly 6,900 for the S&P in front of this week. And so, we've obviously seen Bitcoin and other markets start to crash, and generally those markets lead the S&P 500. So it could be interesting to see how the S&P 500 reacts following all of this. But when we're continuing to keep an eye on the consumer, right? Usually this is a good market or a good time of the year for Wall Street. Everybody's off their yachts and sailing in the Amalfi Coast over the summer in TradFi. But now it's their time to lock in. They're cold. They're staring. They're looking at their computer desks. So this is when usually we start to see the market turn up. And, it's been relatively flat here lately. And I think a big cause of all of that is this job market. People don't know how to read the consumer. I'm going to be diving into a lot of this data and making some more videos on this. So make sure you guys are subscribed to this. And as McLovin is saying, the weak dollar has been needed. Well, comparatively, I mean, at this point, we've essentially been looking at an asset bubble of sorts where, but it is and it isn't, right? It's not like you can throw a dart at the wall and pick 3 letters and it's going to be a stock that absolutely rips like it was during the cerveza sickness a few years ago. But what we are seeing is that we are seeing, the Mag 7 absolutely rip. And these evaluations that we're seeing from these companies are just insane. So be sure you guys are subscribed. Hit that like button. I'm going to be covering all of this, and I'll catch you guys all at the next one.